Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst. It's Friday, 14th August 2026, and joining Lee to pose some questions on the financial market themes for the week ahead is Henry Cook, Senior Economist. This material is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hi, Henry.
Hi, Lee.
How are you doing?
Yeah, not bad, not bad. How are you?
Yeah, all good, thanks. It's good to have you here again on the podcast today. Definitely over the last week, we have seen financial market conditions calm down after the joint intervention that we saw from the US and Japan at the end of July. Obviously, that was intended to help support the yen and the US Treasury market. But since then, we've seen the yen quickly giving back around half of its intervention-driven gains. If we look at the latest positioning data from the CFTC at the end of last week, we can see clearly that there was a sharp unwind of short yen speculative positions by leverage funds after that joint intervention. So from that perspective, it was kind of relatively successful. It did definitely trigger an unwind and discourage kind of short yen positions that have been built up in the market. But as we've seen, I still think kind of broader financial conditions remain supportive for yen funded carry trades. So we may have seen leverage funds kind of gradually, kind of cautiously rebuilding those short yen positions over the past week, even though we have seen yield spreads between Japan and the US narrowing further over the past week. Like the fact that the yen has quickly given back its intervention-driven gains, just to us kind of highlights that it's still kind of a very challenging backdrop for Japanese policymakers who still obviously want to prevent the yen from weakening further. And as we know, kind of intervention on its own really is just kind of buying time, and really for a sustained strengthening of the yen, you do need to see a change in fundamentals as well. That's why it's quite interesting that we are seeing kind of yield spreads between the US and Japan narrowing. That's been driven from both sides. So US yields have moved lower over the past week, and at the same time, we've seen higher yields in Japan. There are a couple of reasons why we're seeing that narrowing of the yield spread. One is the recent run of softer data that we've had from the US, starting with the much weaker payrolls report and softer wage growth. But over the past week, on top of that, we've seen kind of limited evidence of spillovers from higher energy prices into core inflation. And then today as well, we've seen a much softer retail sales print for July, which it sends a kind of warning that maybe the faster pace of retail sales growth that we've seen over the last 5 to 6 months, supported by fiscal stimulus, now that now appears to be kind of waning off, and this could be the start of maybe a softer run of consumption growth in the second half of this year. So when you kind of put it all together, to us, it gives the Fed more leeway to leave rates on hold. There's definitely not a pressing need going into the September meeting for them to begin hiking rates. So that is encouraging the US rate market to move more in line with our view, which we've been kind of saying for some time, that we think the Fed can leave rates on hold in September. And I think if they do leave rates on hold, it does leave the potential there for the dollar to re-weaken as we head into to year end.
And in terms of the BOJ outlook, how do you see that?
Yeah, I think the BOJ outlook has changed as well quite significantly over the past couple of weeks. If you look at the pricing in the Japanese rate market, you can see now that the timing of the next rate hike has been brought forward to the next meeting in September. I think there's around sort of 20 basis points of hikes priced in, which even a couple of months ago would have been seen as something which was very unlikely to materialize. I think when we were calling for a September hike, we were very much kind of out on a limb on our side as probably one of the most hawkish forecasters in the market. But that's looking more and more likely now after recent developments. Obviously, we've had much more hawkish rhetoric from BOJ officials, including Governor Oweda at the last press conference, where he signaled that definitely a September hike is on the table. And since then as well, we've also had kind of media reports suggesting that the Japanese government is supportive for the BOJ to deliver another rate hike soon. To us, that kind of fits with our own view that we think the US agreed to joint intervention alongside Japan, so long as the Japanese government was also willing to do more in terms of allowing monetary policy to continue to normalize. Like I say, I think the US is obviously of the same view that you need to see a change in fundamentals for the yen weakening trend to reverse. And one of the kind of key drivers which could trigger a more sustained strengthening of the yen would be if we were to continue to see yields in Japan moving higher from here. So we do think that those developments are definitely moving in a more supportive way for the yen, but as we've seen over the past week, maybe not yet sufficient on their own to turn the tide in the FX market. I know, Henry, you've also been kind of looking at recent economic developments here in Europe. What have been your kind of main focus points over the past week?
Yeah, it's been relatively quiet here. Not much data out recently. We did have the UK GDP numbers for Q2, and it was a pretty good number, 0.4% quarter on quarter, which I think should be seen as a pretty good result in the circumstances, against that backdrop of Middle East uncertainty, higher energy prices. It's been a story of resilience for the UK economy. To put it in context, really, I was looking back at my forecast in January at the start of this year, and I was expecting UK growth at 1.2%. And that's exactly what I am now tracking, despite everything that's happened in the Middle East. So that kind of shows the kind of resilience story here. In terms of the actual drivers of the Q2 growth figure, mostly it was an investment story with a bit of support from consumer spending. There was a bit of a drag from government consumption after schools were closed during the heat wave. Hot weather might have affected construction output as well, but boosted hospitality spending. So there were some kind of volatile factors here. I think in terms of the overall picture, it's one of resilient domestic demand in the UK, and that's been underpinned by kind of strong services sector output.
Interesting. Like looking at the service sector data in more detail, like there has been some kind of optimism recently that maybe the UK economy could be boosted more from the rollout of AI. Do you see any signs of that?
Yeah, absolutely. I think there is a kind of broad cyclical recovery in professional services, especially, but I think that is being boosted by AI adoption in the UK economy. In particular, it's increasingly showing up in the capex numbers, in the investment numbers. Business investment was strong in the GDP figures, 1.7% quarter on quarter. That's a good result. And it was noted that information and communication technology was a big driver of that. And I think, taking a wider view, I think there is some interaction here with the kind of post-Brexit catch-up dynamic. If we cast our minds back, business investment was essentially stagnant in the UK for quite a long period after the Brexit referendum. So there is a kind of catch-up dynamic there. I think in many cases AI is proving to be the catalyst for stronger capex in the UK economy.
Does that make you kind of more optimistic over the outlook for growth going forward?
Yeah. I think that will underpin and support activity going forward. In the near term, the June monthly GDP figure, that was quite good, 0.3% month on month, which kind of points to strong momentum into Q3. Survey data has been okay in July. We'll get the PMIs for August next week. Look, I think the economy would do well to repeat the performance that we saw in Q2. Energy costs are still passing through to the economy. Inflation is set to rise over coming months. I'm kind of penciling in a peak of around 3.5% in Q4. This will all chip away at real incomes. And the other big kind of risk theme, of course, is the UK budget in the autumn. That's looming over everything. In recent years, we've had this pattern of speculation about potential government policies weighing on spending and investment decisions in the autumn. I mean, the new Prime Minister, he started relatively well, looking at the polling numbers, but the fiscal reality remains the same. There really isn't much space there to do anything. Those kind of good GDP numbers we've talked about, they help a little bit, but in terms of the fiscal headroom, it's completely dwarfed by higher borrowing costs following the US-Iran conflict, and also a higher defence spending commitment. So yeah, the kind of OBR's estimate of the headroom, I think, could be slashed in half coming into this autumn budget period before any new policies are announced. So it's going to be difficult. I think there is a good chance that speculation weighs on UK activity again in the autumn. But yeah, if we look past that kind of volatility, as I said, it's been a good start to the year. That does show a degree of resilience, and kind of on an annual basis, as I said, 1.2% GDP growth would be a good outcome. It might disguise a kind of bumpy profile, but yeah, it would be a decent enough outcome for the UK economy.
How do you think that would kind of feed into the Bank of England's decision making?
Yeah, I mean, they will note the resilience of the economy for sure. Our base case remains that policy rates will be left unchanged this year. There's plenty of slack in the UK labour market. Vacancies are pretty low. There's essentially no evidence of second round effects from higher energy prices in the broader inflation numbers still. As I said, next week we get the PMIs. Those will shed a bit more light. We also get the latest inflation numbers for July. We get the latest labour market numbers. So it will be a busy week of data next week. A lot of stuff which will be relevant for the Bank of England. But I think for now, the Bank of England officials, they're not showing much urgency as a whole. There are some hawkish dissenters, of course, but as a whole, not much urgency there. In particular, that could change, especially US-Iran. We've talked about it. That situation remains unresolved. But our sense is that the MPC as a whole would like to hold off from raising rates if it can. And so our central scenario is that UK bank rate will be left unchanged.
Great. Thanks, Henry, for sharing your thoughts on the UK economy and Bank of England policy. That brings an end to today's podcast. Thanks, everyone, for listening, and have a good week ahead.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.